Bitcoin isn't broken, but it's different. Bitcoin once belonged to the outsiders, a quiet idea passed between cypherpunks, technologists, and everyday people who believed in something better than the financial system they saw crumbling around them. It didn't ask for permission, it didn't require a broker. It simply existed, a way for people to exchange value without banks, borders, or institutional interference. Today, that same Bitcoin is being bought by governments, held in the reserves of trillion-dollar institutions, and traded on stock exchanges through regulated financial products. The asset that once powered internet forums and DIY mining rigs now fills headlines, ETF filings, and investor decks. Bitcoin hasn't disappeared, but something's changed. It's grown up, and in growing up, it's entered the world it once stood apart from. When Satoshi Nakamoto published the Bitcoin white paper in 2008, the intent was revolutionary. A peer-to-peer electronic cash system. It wasn't meant for hedge funds or asset managers, it was meant for us, the people who wanted a system that worked outside of traditional gatekeepers. But that vision has evolved. Bitcoin's no longer primarily used for payments. It's rarely described as electronic cash. Instead, it's framed as digital gold, a store of value, a hedge, a speculative vehicle. This rebranding wasn't accidental. It emerged as institutions entered the market, bringing with them language and expectations of traditional finance. More Bitcoin is held in custodial systems than in self-owned wallets. It's still decentralized, but the average user no longer touches the protocol directly. Bitcoin isn't broken, but it is different. As the institutions pour into Bitcoin, the road ahead seems to be splitting in several directions. The most visible and most likely path is one where Bitcoin is absorbed into the financial mainstream. It becomes just another asset on the books of hedge funds and sovereign wealth portfolios bought through EFTs, held by custodians, and increasingly surrounded by regulation. It's no longer disruptive, just familiar. A digital version of gold integrated neatly into the system it once stood against. But that's not the only direction. A quieter and highly plausible future unfolds alongside it, one where two distinct Bitcoin economies begin to coexist. One side is institutional, compliant, and governed by financial gatekeepers. The other remains grassroots and sovereign, held in self-custody and used peer-to-peer in parts of the world where currency instability and authoritarian control make freedom a necessity. In this parallel economy, Bitcoin still lives as it was originally intended, as the money of the people. There's also a more helpful, though less likely scenario in which Bitcoin doesn't just fit into the system, but transforms it. It nudges finance toward greater transparency, faster settlements, open ledgers, and fewer middlemen. But this is a slow and uphill battle. Institutions rarely change themselves, and the further Bitcoin climbs into polished conference rooms and regulatory frameworks, the more its radical edge gets rounded off. And then, sitting at the far end of possibility, but not beyond reach, is the risk that Bitcoin becomes so shaped by institutional pressure that it loses the very values that made it revolutionary. Not through hard forks or protocol changes, but through soft influence. Blacklisted wallets, compliant-only wallets, and custodians that quietly steer the network's behavior. It's the least likely scenario, but the one that must always be guarded against. Whether Bitcoin becomes a global monetary standard, a neutral reserve, or just another asset in portfolios, the question is the same. Who will it serve in the long run? The powerful or the people? In Bitcoin's early days, retail investors were the pioneers. They mined, ran nodes, shared ideas, and took risks before the mainstream even noticed. But as Bitcoin matures, the role of the individual has shifted. Mining is no longer accessible to everyday users. Accumulating whole coins is out of reach for most. Participation in governance is minimal, and the dominant conversation has moved from decentralization to regulation, from sovereignty to price. Retail didn't lose, but it no longer leads. Bitcoin's global relevance is undeniable, but if its use becomes increasingly custodial and compliance-bound, then its original promise of a peer-driven system must find new soil in which to grow. The story of Bitcoin was never just about wealth, it was about access. It gave ordinary people a way to participate in a financial system that didn't require permission, paperwork, or privilege. That promise hasn't disappeared, but in a world now dominated by institutional custodians and ETF filings, it's become harder to see. Radiant steps into that space, not as a replacement for Bitcoin, but as a continuation of its original spirit. It launched without venture capital, without a pre-mine, and without a central authority. Governance belongs to the network, not the insiders. The rules are public, predictable, and apply equally to everyone, whether you hold one coin or 1,000,000. Radiant offers a place where people can build and contribute, not as spectators, but as participants. It doesn't ask for credentials or capital, it invites presence, effort, and initiative. In a time when the financial system is becoming more centralized, more filtered, more watched, Radiant gives people a place to create and transact on their own terms. It's not just another coin, it's a tool, a platform, a foundation for those who still believe in bottom-up systems, for sovereign builders, for dreamers who never bought into the idea that freedom should be licensed or permissioned. Bitcoin's institutional era is here. It's entered the portfolios of billion-dollar asset managers, become a macroeconomic talking point, and woven itself into the financial strategies of nations and corporations alike. That's not failure, that's validation. But validation comes at a cost. As Bitcoin becomes more integrated into the legacy system, it risks becoming less accessible, not in price alone, but in purpose. The very thing that made Bitcoin revolutionary wasn't just its scarcity or technology, but its openness. Anyone could shape the network, anyone could build on it, and for many, it was the first time they felt financially included. Today, that door still exists, but it's no longer the only one. Projects like Radiant are building new paths from the same core principles: decentralization, fairness, security, and sovereignty. These are systems not designed for passive investment, but for active participation. They don't promise wealth, they offer tools and the freedom to use them. This is not about replacing Bitcoin. It's about carrying forward the values that made it better. So, as Bitcoin finds its role among institutions, a new frontier opens for those who still believe in bottom-up innovation. For those who know the future isn't something to watch happen, but something to build.